Huge news in the media business after the market closed on Tuesday. And of course, this happens a day before Disney is going to report earnings Wednesday. But Disney, Fox, and Warner Brothers Discovery have come together to say that they're going to launch their own streaming service that will be focused on sports. The details are not quite finalized yet, but it appears that at least most of the content on ESPN, Fox Sports, and Warner Brothers Discovery's properties like TNT are going to end up on a streaming app. And that app will be distributed through places like Disney Plus and Hulu, and then also through Max, the Warner Brothers Discovery streaming service. This is a massive shift in the streaming sports business. And this is one of the last dominoes to fall in streaming. I think we've clearly seen Netflix become the leader in kind of general entertainment streaming. And then you have Disney Plus with the IP that they have built out with things like Star Wars, Pixar, Marvel. And then you have a lot of struggling streaming services. I think Max falls in that category. You have Peacock, and there's a ton of other smaller streaming services that I think just probably aren't long for this world. But the missing piece here was always sports. What is the future of streaming sports going to look like? We've seen Amazon try to take a crack at the NFL. Apple has taken a piece with MLS, with soccer in the US, and YouTube has taken a piece of the NFL as well. But now a lot of content is going to end up on this streaming app. So this could create a new juggernaut in streaming, and these three companies are at least going to be friends for now with as this business is built out. So I'm going to go through the details today and how to think about this, particularly through the lens of Disney, Fox, and Warner Brothers Discovery, because those are the three big players involved here. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool, you go to fool.com/ASYM. You're going to give you their top 10 stocks to buy right. So let's go through the announcement and what we heard from all three companies in a release today. This is the release, and I pulled it from Disney's site. So ESPN, Fox, and Warner Brothers Discovery forming a joint venture to launch streaming sports service in the US. There are a bunch of details here, but the biggest thing is that these three parties are going to be equal owners of this streaming service, which is going to be a standalone service, and it's going to be under its own brand. We don't know what that brand is going to be, but there's going to be a new name and a new brand, a little bit like Hulu when Hulu was launched, and that was a partnership with a bunch of these media companies years and years ago. Now is going to be owned just by Disney, but originally the structure was, I believe it was 4 companies that owned pieces of Hulu. And the key for this is that the streaming service is going to aggregate content to offer fans an extensive, dynamic lineup of sports content to serve fans outside of the traditional TV bundle. This is a whole list of some of the channels that some of this content is going to be coming from, but the ESPN channels, SEC Network, ABC, Fox, FS, TNT, TBS, and of course ESPN Plus as well. And this is going to be coming in fall 2024. So it seems like this is actually fairly far along, but this is going to be built from the ground up. And you are going to be able to bundle this through Disney Plus, Hulu, and or Max. I think that's a really critical piece because distribution for a service like this is going to be really critical. This is something that particularly Disney Plus has seen, is that the challenge is how do you continue growing your service when you're building out a new business like this? And what they're going to do is kind of ride the tailwinds of these existing services. So the key here is that these two, which are owned by Disney, are the biggest distribution sources. So as we start to think about the economics of what this looks like, I think that is really going to play a role, because I think it's interesting that this is going to be equally owned by all three companies when all three companies are not bringing equal assets or equal distribution to the table here. Here's the ownership piece. Each entity will own 1/3 of the joint venture, have equal board representation, and then license their sports content in a non-exclusive basis. This is really key. This means that the content could go on other services as well. So maybe you do see some of the ESPN content also end up on a place like Disney Plus. This is also going to be an independent management team. So a subsidiary of all three companies, or owned by all three companies, and completely independent management isn't going to be run particularly by one company. So really interesting setup here. All three executives gave little statements here, but I think at the end of the day, they're all excited to be part of what they think could be the most powerful sports streaming service in the US. At least that's the vision for right now for this service specifically.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
Now, as we think about what this business looks like in the future and what the economics are, I think that's where things start to get a little bit murky. I talked about these companies not necessarily bringing equal assets to the table. I think on the surface, it looks like Disney was probably in a pretty weak negotiating position. If they're giving up an equal ownership position in this joint venture to a company like Fox, who didn't have any streaming assets and has relatively limited sports assets with just the Fox network, FS1 and FS2, ESPN is bringing a lot more to the table, especially with the assets that are included with ABC. So from both a distribution standpoint and a sports asset standpoint, it doesn't seem like those companies are equal, but they're obviously going to be equal owners in the joint venture. So it'll be interesting to see what we learn about how the economics work. Are the content payments going to be tied to something like hours watched? That maybe would make sense. Is there going to be a cut that goes to distribution, whoever sells or bundles the streaming services? That are they going to get a different take on the monthly fee that customers are going to pay? I think these are all things that need to play out. And it doesn't sound like the negotiations are quite finalized. There is a line at the beginning of this that says they've reached an understanding on principal terms to form a new joint venture. So it seems like the ink is not dried on exactly what these details are, but the basic outline or the broad strokes are really figured out. So they probably know exactly what is going to happen. So these things are probably figured out, but this is not being released, at least to the public right now. So we'll see if we hear anything from Bob Iger specifically on Disney's conference call on Wednesday. But that's one of my biggest questions here is, I think as a Disney shareholder, I was looking at Disney Plus and Hulu being a really strong number 2 position to Netflix in the streaming wars. And then if you add in something like ESPN going over the top and bundling those 3 together, that was a really strong position to be in. This is going to be a much better asset, bringing in the content that Fox and Warner Brothers Discovery has to that bundle, but you're also diluting your ownership at the same time. So Disney only owns 80% of ESPN. Now they're going to own a third of this joint venture. They're going to own less than 30% of this joint venture. So what is ultimately the benefit? Is it just to make that bundle more valuable? Is there going to be economics associated with the sports rights that are going there? That all remains to be seen. I think the bigger picture, if we're looking at this as a positive, is that all 3 of these companies really saw that they were not going to have the balance sheets or ability to build a sports streaming service by themselves. Even ESPN and Disney, given their size and balance sheet and the size of Disney Plus and Hulu from a streaming perspective, probably wasn't going to be able to write as big a check as Alphabet with YouTube or even Amazon or Apple if they really wanted to write a big check for something like the NBA or NFL rights in the future. And the NBA specifically is going to be the one that's coming up later this year. We also have a lot of uncertainty around regional sports. The Bally sports networks, which are going through bankruptcy right now, could have some of their licenses freed up at the end of this year if their bankruptcy is not finalized in some of the deals that are being worked out right now, because there's basically an out for the NBA specifically to get out a lot of those deals after this NBA season. So those could be up for renewal. And who's going to bid on those? Is it going to be ESPN by themselves? Is it going to be TNT by themselves? Or is somebody like Amazon, Apple, YouTube going to win those? So all these companies are kind of in a desperate position. And I think that's maybe why we got this deal done right now, because this has to be figured out before these NBA negotiations really begin in earnest. And now all 3 of these companies are going to be bringing assets and distribution to the table with the streaming service. So that's at least one way to think about this. If you're Disney and you're maybe bringing the most to the table with this joint venture, the risk was we were going to lose out to all these tech companies, and maybe they were not offering attractive partnerships. So you're at least bringing some of these assets. But I think ultimately the winner here seems like Fox. They have some sports assets, but not a lot. And they do not have a significant streaming business. So this is a way for them to have a third of likely one of the biggest sports streaming businesses in the world. And we'll see if this is going to just be in the US or if they have global ambitions for this as well, at some point in the future. But I would say that's the company that really is the winner here. And this also gives Warner Brothers Discovery an out, maybe a little bit more runway to grow the Max business and maybe become the number 3 player in streaming along with Netflix and Disney with its properties. But I would say generally this is going to be bullish for all three companies because it means that they're not going to be losing out, at least not yet, to big tech in streaming sports. And there's at least a clear strategy for the future with how you're going to grow this business, how you're going to get distribution rights, and get all three of these big media businesses moving in the same direction. So that's my initial take here. We'll see what we learn on the conference call. I'll be back to cover that from a Disney's perspective. Iger is usually pretty tight-lipped with a lot of these things, so it's possible we don't really learn anything. But I think this at least gives a pathway forward for streaming sports, which is positive for all three of these companies. And we'll see how those details are filled out and how the economics are going to look. But what do you think about this? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.